Okay, guys, I'm going back to Ask Scruff. Now, I was typing this out for Albert's dad. Salute to you, kid. But I think it's easier to come to camera for the second part. Okay. So, yes, we're getting ready for the conference this weekend. That's what this is. And guys are having a little bit of a chat. But if I come down into the clinic, and I go to Ask Scruff, because I've been very busy today, obviously preparing for that. It's here. So originally, I was asking about leverage and what I was doing earlier on. And I just typed it out. Yeah, you need about 1,100 quid per pound of margin if you're living in the EU, because it has 1 in 30. However, if you're on BlackBull, you can have 1 in 500 and you don't need as much margin. But the kicker is what came next. So, I said Albert's dad. It's Degen dad. Albert's dad is another one. But I'll give you a salute as well, Albert's dad. Degen dad. I'm getting old, boys and girls. I'm getting old. The brain isn't what it used to be. Well, it was never very good to start with, to be honest. So, for example, a 1k account on capital. You set 5 times 0.2 takes it 900 margin. Am I okay on that basis? My stop loss, or would it sooner 900 liquidated? Okay. Right. Let's kind of talk margin a second here. Margin is how much you're willing to put into the market as a deposit. Now, if you've only got sort of limited sort of access, sort of one-on-one, well, then you've only got 900 quid in the market. If you've got a leverage of 1 in 2, obviously it increases. 1 in 500, it's massive. But what that means is, yes, you can put a big position on, because obviously the deposit you're putting in might be small. The margin increases that buying power, enabling you to put a bigger position on. What happens is, though, you've put your account at risk. So the rule of thumb is whatever you're putting in the market for real money, you want 2 times in your account. So in this equation here, if you was going to sort of go in with £900 worth of margin on 1,000 capital, it ain't going to last long, because the second that moves against you, you're going to start getting a margin call because your deposit isn't going to cover it. So what you would really need in that scenario is actually a 2,000 account. 900 up, and then you've got 900 worth of movement to stop you getting your margin call. So in that scenario, I would say that is too high. Now, you're correct in the sort of 5 times 0.2, because you work on a pound per 1,000. But you've also got to be realistic with the asset that you trade. On the DAX, it's incredibly expensive. So you are still putting a pound 1,000 in, but you've used all your margin just to open it up. Got nowhere to go. But if you looked at a cheaper market, sort of euro pound, the FTSE for argument's sake, they are far cheaper. You can still open up your pounder position based on your 1,000 account, but it would have enough in it that you won't get a margin call. I hope that makes sense in a strange way. But ultimately what you do is you position to the size of liquid money you have. So in this scenario, 1,000. So the most you can put in is £1. And then you've got to keep an eye on the margin to make certain you won't get a margin call if it comes against you. Well, if you're maxing out your margin just to open up the position, you can't afford that asset. Okay, and that's kind of the rule of thumb. So that's the way I would look at it. And there are other ways around it. Like I say, you go to BlackBull and you put a higher leverage account in it. You won't get a margin call, but you still stick to your pound. Just something for you to think about. Okay, guys, hope that helps. Catch you soon.